Ever feel like you need, I don't know, a secret decoder ring just to figure out what's really going on in a company's earnings report?
Yeah, wading through all the numbers, the jargon,
Yeah,
it can be tough to find the actual insights.
exactly. So that's what we're doing today. We're going deep on Netflix's latest numbers, the Q2 2025 earnings call.
hmm And we've pulled together everything, the call itself, the key metrics, news reports, kind of collated it all to hopefully cut through some of that noise for you.
Yeah, the idea is to break down the key numbers, the big strategic moves, and what's driving their growth now.
Turning that potential information overload into, clear understanding, those aha moments.
So let's just jump right in. Netflix, Q2 2025, they beat expectations, right? That seems to be the headline.
That's right. Pretty much across the board. And it's not just a one-off. This continues a pattern we've seen.
Okay, so what were the standout figures this time?
Well, the earnings per share, the EPS, that came in at $7.19. The forecast was 77 cents. So a solid beat there. And revenue hit $11.08 billion, just edging out the $11.04 billion target.
Right, so not huge beats, but consistently beating.
Exactly. It shows strong operational discipline, I think. They're not just growing the top line, they're converting it to profit efficiently. That's pretty key.
And that seems connected to some pretty hefty spending, especially on content. We're seeing cash content spend going up, right? From $17 billion last year to, what, $18 billion planned for 2025?
Yes, that's a big number. And it ties directly into their growth targets they're aiming for, I think 12-14% top-line revenue growth.
Which is ambitious.
It is. But what's interesting is how they're doing it. While content spend is up, overall expense growth is projected lower, around 9%.
Ah, so that points towards margin improvement. Smart.
Definitely. A real focus there. And speaking of growth, this might surprise you, Netflix estimates. Even now, they've only captured about 6% of their total addressable market globally.
Wait, 6%? Seriously, after all this time?
6%. That's their estimate. So, despite feeling ubiquitous, they see this huge, long runway for growth still ahead.
Wow. Okay, that 6% number, it really reframes things. But, I mean, let's play devil's advocate for a second. Tapping into that other 94%. It can't be easy, right?
Yep.
What are the real hurdles there? Culture, infrastructure, competition.
Oh, absolutely. It's a huge challenge. You're talking about markets where maybe internet penetration is still growing, different viewing habits, intense local competition.
Right.
So it's not just flipping a switch. It means a serious, sustained push into localization, creating content that resonates region by region, language by language. It's complex.
And expensive, I imagine.
Very.
Yeah.
Especially when you consider there's still below 50% penetration of connected households in many of these potential growth markets.
Okay, so that's the sort of long-term picture, but they've also made some big strategic shifts more recently that seem to be paying off now. Let's talk about the ad-supported tier. That seems to have been, well, surprisingly successful.
Surprisingly, might be underselling it. It's been incredibly successful. The numbers are pretty stark. They saw a 30% jump in ad memberships just quarter over quarter.
30%? Wow.
Yeah. And maybe even more telling, over 55% of all their new signups are now coming from regions where that ad tier is available.
So it's really driving new user growth.
Massively. And it's bringing in serious ad revenue, too. It doubled in 2024, and they're forecasting it'll double again in 2025.
And they're building their own ad tech now, too, right? They launched in Canada, U.S. rollout planned. Is that a big deal?
Oh, absolutely. Building their own ad tech stack gives them much more control. They can optimize the ad experience, offer different formats, and, crucially, keep a larger slice of the ad revenue pie instead of relying on partners. It's about owning that whole value chain.
Makes sense. And it's not just ads changing the offering, is it? They're pushing into live content, too. We've seen NFL games, WWE Raw.
Right. And the FIFA Women's World Cup deal for 2027. It's a clear move to broaden the definition of Netflix beyond just on-demand movies and series. Live sports and events bring in a different audience, different engagement patterns.
And then there's gaming.
Yeah, the push into narrative-driven video games, often leveraging their own IP, like from their shows.
How significant is that, do you think? Is it just a side project or a core part of the future?
I think they see it as potentially very significant. The gaming market is enormous, like $140 billion, enormous. If they can successfully blend streaming and gaming.
Like watch a show, play the game.
Exactly. It creates a much stickier ecosystem, keeps people engaged longer, potentially opens up new revenue streams. It's about maximizing the value of the worlds they create.
Okay, so strong numbers, big strategic plays in ads, sports, gaming, huge untapped market. Sounds pretty good. How are the analysts seeing it? Wall Street's take.
Well, the consensus is definitely positive. You've got, what, 42 analysts covering the stock.
Right.
The overall rating is a strong buy, around 1.92 on the scale they use.
Okay, strong buy. Price targets.
They're pretty varied. Barclays is down at $900, but the high target goes up to $1,600. The average or mean target is around $12,277.88.
Right. But hang on, I saw something about a negative fair value upside, like negative 22%. How does that square with a strong buy?
Ah, yes, that's the crucial context. That negative 22% means the current stock price is actually trading significantly above the average analyst price target.
So the analysts are bullish, but the market is even more bullish.
Precisely. The stock's been trading near its 52-week high, around $13,341. It suggests that the current market price has already baked in incredibly high expectations for future performance.
Even though the fundamentals look solid, I saw they have a perfect Piotrowski score of 9, which sounds good.
It is good. The Piotrowski score looks at financial health, profitability, leverage, efficiency, and a 9 out of 9 is excellent. It shows the underlying business is robust.
But the market's still jittery. We saw that little dip after earnings, right? Like 1.7% down pre-market.
Exactly. And that dip wasn't really because the results were bad, they were good. It was because the market had priced in, well, maybe something even more spectacular. Those sky-high expectations weren't quite met, even with strong results.
So it's the classic buy the rumor, sell the news kind of thing almost.
Sort of. Or maybe just the market recalibrating after a strong run-up. You have to remember the valuation context. Netflix is trading at a high price-to-earnings ratio, around 49x.
49 times earnings. Okay, that's steep.
It is. That kind of multiple implies investors expect really significant, sustained growth and continued margin expansion to justify the current price.
So, okay, let's try and synthesize this for you listening. What are the key takeaways here?
Well, I think it boils down to a few things. First, their execution is strong. That margin discipline alongside content investment is key.
Right. Second, the global strategy focusing on that huge untapped market combined with localization.
And third, the new growth levers, particularly the ad-supported tier, are clearly working and scaling fast.
But the big but is the valuation, right?
That's the crux of it, yeah. The company is performing well, innovating, growing, but it's trading at a premium. That price is only really justified if they keep firing on all cylinders, hitting those high growth numbers, and expanding margins consistently.
It's like a tightrope walk.
It really is. Balancing delivery today with fueling the huge expectations for tomorrow.
So Netflix keeps pushing boundaries, ads, sports, games, and honestly keeps delivering strong results. But that current high valuation and the market's kind of twitchy reaction, even to good news, what does that tell us? Does it maybe signal something about the future for these big established tech players? Are the goalposts for success just constantly moving higher, demanding near perfection just to keep the market happy?
That's the big question, isn't it? Something to think about.